Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Let's talk about bull call spreads now with our options guru, Kevin Matras, who joins me. Actually, bull call spreads in the context of big gains on small moves. Now, you and I have never talked about this before, but this is a strategy that you use.
Yeah, it's weird because, we've been doing these know your option pieces for quite some time, and I don't think I ever really did a piece on bull call spreads, but I use this strategy very, very often, so I figured now would be a really good time to do it. Plus, too, I just put a bunch of bull call spreads on, and we're going to talk about that today. But a bull call spread involves buying a call option and then simultaneously selling a higher strike call against it. This is put on as a debit, and as the name suggests, it is a bullish strategy. The caveat, though, is that it does have a limited profit potential. So in this respect, I think this is why bull call spreads may not be as exciting to some investors as just buying a long call, because, right, somebody buys a long call, they fantasize the stock is going to skyrocket and they're going to make gobs of money. But how often does that happen? And this is one of the benefits of using a bull call spread. So
maybe not as popular because everybody expects their stocks to skyrocket?
Yeah, everybody does, and so they just want to go straight long because there's unlimited profit potential when you just have a straight long call. There's no cap. But most of the time, stocks don't skyrocket, and if the stock ends up making a more mediocre move, and let's say it takes longer for that move to happen, the problem is that the options purchaser is always having to worry about time decay. So if time ticks away, if you're in a stock and you just see the stock go sideways and base for a little bit, no big deal. Once the stock starts moving up, you're fine. But with an option, every single day that underlying stock doesn't do anything, it's eating away at your premium. The benefit with the bull call spread is that since you wrote an option against it, that time decay is actually working in your benefit. So that's another benefit of having a bull call spread as opposed to just purchasing a long call.
You also say it's a good way to be able to get into options for lesser money.
Yeah, you take a look at some of the very, very popular stocks. Some of these stocks are trading at hundreds of dollars, which makes a lot of these options, decent options, go for $2,000, $3,000, $10,000. And it's hard to pay that kind of money for an at-the-money option, let alone an out-of-the-money option. And these ridiculous prices oftentimes will keep the options purchaser from getting into these opportunities. These are great opportunities if you could only figure out a strategy to be able to get into it. But again, if you're buying a ridiculously priced option, when you're selling the one above it, you're also collecting premium on that wildly overpriced option. So the net result is that you can actually get yourself into that exciting stock for a fraction of the cost of what it would take to get into a long call.
All right, give us some examples.
Yeah, so let's take a look at an example. Now, I just did a bull call spread in Tesla Motors. And Tesla Motors, when I put it on, was trading at $184. Now, I put this spread on February 3rd of 2014, so that was like, week and a half ago or something like that. It was a number one ranked stock. Zacks ranked number one. It looked fantastic. I had to get in. So it was at $184. But the problem was that the call options were just ridiculously expensive. The 185 call was going for $22.02. In other words, it was costing $2,202. In fact, it's right here on the screen. So the bull call spread I ended up buying was this. I bought the June 185 call at $2,200. but I simultaneously sold the June 195 at $18.24. In other words, I collected a credit of $1,824. So my total cost to get into this bull call spread was $378. So remember, if I had only bought that long call, I would have had to have invested $2,200, $2,202, whereas here I only had to pay $378.
And you're making money how?
So here's how we make money. So I got a couple of scenarios. Scenario one, if Tesla at expiration, and for this June spread, I've got 4.5 months, so it's going to expire the third Friday in June. It's 4.5 months from where we are. If it were to go up to 195, the 185 call would be worth $10, which is equivalent to $1,000, because that option is now $10 in the money. That would actually generate a loss of $1,202. But the 195 call that I wrote would now be worth $0 because it's out of the money, which means I would keep the entire $1,824 I collected. So I made $1,824 on that call. Add those two things together, and I have a gain of $622 on an investment of only $378. That's a 164% gain, and the stock, right, it was at 184, all it had to do is get to 195. The stock literally only had to move just less than 6% in order for me to make this gain.
All right.
Scenario two.
Yep.
Now let's say at expiration, let's say Tesla were to make a very sharp move. Let's say it goes to 225, 250, whatever, sharply above 195. The 185 call would now be worth $4,000 because now it is $30 in the money. That is $1,798 profit on the call, $1,798 on that call. However, the 195 call would now be worth $3,000, which means I would have a loss of $1,176. But again, if you add those two together, it still comes out to a gain of $622. Now, it should be noted that if Tesla skyrockets, the short call at 195 does limit your gains. But even though you are precluded from making any more than $622, you still made $622 and you still made a 164% gain. Pretty awesome.
All right, you got a couple of more to go through.
Scenario three. Let's say Tesla ends up closing pretty much where you were when you got into it. Let's say 185, okay? Let's say it closed at 185 below my lowest strike. The 185 call would now be worth $0, which means I've lost all that I paid for it. I've lost $2,200. The 195 call would also expire worthless, meaning I would keep the $1,824 I collected as my profit on that one. But again, add those two together and you get a loss of $378. So my loss is always limited to what I paid for the spread in the first place. Now, if Tesla were to close $1 above my lowest strike, now instead of losing $22.02, I'm only losing $21.02, which means my loss is no longer $378, now it's only $278. If it closed at $187, now my loss is only $178. Knowing that we paid $378 for this spread, my break-even point comes in at $188.78. So all Tesla really had to do is go to $188.78, and I won't make anything, but I also won't lose anything. And as it keeps on going up from there, I will make a proportional profit. But when it gets to 195 or higher, I am capped out. But again, I still have a potential $622. Pretty cool. Here's the last scenario. Let's just say Tesla plummets. It closes below 185. Let's say it closes at 100 or somehow they bankrupt the company. It doesn't matter. Take your worst case scenario possible. If Tesla were to close below our lowest strike, I am still only going to lose $378. So I have a very small investment, tiny amount at risk, but I have a pretty good profit potential, and that's what makes it exciting.
All right, those are a lot of scenarios.
Yes.
So sum it all up
All
for
right,
us.
here's the summation. So let's just review what happens when you're doing a long call. If you did a long call, if you bought the June 185 when Tesla was trading at 184, that would have cost you $2,202. Tesla would have to climb to 207.02 just to break even. That means you would need a 12.5% move to not lose any money. It would also have to go up to $213.24 in order to make $622. So you would need a 15.89% move to generate a 28% return on that investment. Your max risk, though, is still $2,202. For the bull call spread, here's what it looks like. The June 185-195 bull call spread costs $378. Tesla would only need to get to 188.78 to break even. So I only need a 2.6% move in order to break even. To achieve my maximum profit potential, it would need to get to 195, but that's only a 5.98% move to make a $622 gain, which is a 164% return. And again, my max risk is only $378. So if you do the math, you'll realize the math usually looks phenomenal with a bull call spread. And I will say, when I came down here today, Tesla was trading over $200. Now, Tesla doesn't have to do anything else. It could even go back down to 195. And if it stays above 195, right now it's at $200, at mid-June, right, third Friday in June, that spread will net me a gain of $622. It's painless. I don't have to worry about what's happening, and I just think it is a fantastic way to go. And if you're looking for a way to get into, very expensive stocks, or if let's say you have a mildly bullish outlook on something where you only expect to see a small move, you can really, really take advantage of these types of things with a bull call spread, and I highly recommend this strategy.
All right, and today is actually code for intraday, February the 13th.
There you go.
Yeah, okay. And you can track out some other options information. In fact, there's a text version of this particular explanation of the bull call spread on our website at Zacks.com in the options section of the website. But there's also other options information that's in that options section of Zacks.com as well. So if you're not there already watching this video, get on over and link to it all right off the home page. This information and other stuff you'll find in the options section of the website. All information to help you know your options. With Kevin Matras, I'm Terry Ruffalo.